Hello, everybody. This is Tchaikovsky. Welcome. We're going to go ahead and today and look at some bond issuances. So let's go ahead and take a look. So we're going to be looking at the issuance of bonds. Just a couple problems here using present value tables. This presentation is by the accounting professor, or excuse me, accounting professor, yours truly, Bennett Tchaikovsky, all rights are reserved. Any redistribution is strictly prohibited without my prior written permission. And any opinions and or expressed herein or any other bad, horrible dad jokes are those of myself and do not represent those of Irvine Valley College or the South Orange County Community College District. So let's go ahead and take a look at our first question. So over here on 1/1/29, we issued a 10-year bond with a face value of for 10 million. The bond had a stated rate of 10% and the market rate of interest was 12%. The bond will pay interest semi-annually, and we want to prepare the journal entry to record the bond issuance. So a few things here. We're talking about basically financing. And so, what exactly is a bond? A bond is like an interest-only loan. Every 6 months or every year or every quarter, the company pays the interest on it using the stated rate. And then at the end of the bond's term, the full amount of the principal is repaid. However, when it comes to bond pricing, so if we have a stated rate of 10%, and this is less than the market rate of 12%. So when we look at a bond's pricing, what we have to kind of see is, well, will anybody want this bond? Well, if I can earn 12%, would I rather earn 12% than earn 10%? And that answer is going to be yes. So what's going to happen is because the stated rate is less than the market rate, the bond will be issued at a discount, meaning that the cash proceeds will be less than the face value of the bond. So what the journal entry is going to look like if we have a discount on 1/1/29, which is our date, I'm going to debit cash and I'm going to credit bonds payable. Now, when I credit bonds payable, it is always for the face value of the bond, or in his case, it is going to be $10 million. So coming right over here, now the cash I know is going to be less than the face value. Why? Because my bond, what I'm offering or my stated rate on my bond is less than the market rate of interest. So over here, my other entry is going to be to a discount on bonds payable. And then this is going to be to record bond issuance. Okay. Now that we have that out of the way, the next thing we need to figure out is that how is the bond priced? So we have two different forms of payment. Basically, we're going to have 10 million, and this amount is going to be paid to us in 10 years. And we also have interest, right? So, but this interest is being paid semi-annually or twice per year. The way we're going to go through and figure out the interest is going to be as follows. We have 10 million that is being paid. That is the face amount of the bond. The stated rate of interest is 10%. Note is not 12%, it is 10%. This is the stated rate of interest. Now, whenever we see an interest rate, it is always an annual rate. So the annual amount of interest that this bond will pay is going to be 1 million. However, because the interest payments are coming every semi-annual, the interest payment every 6 months is going to be $500,000. So I now know that there is going to be a cash payment of $10 million at the end of 10 years. And we're going to get 500,000 of interest 20 times, or meaning twice per year for 10 years. Now, at this point, we have to kind of distinguish between the two of these. This is a lump sum payment. It's only being paid out once. So the table I'm going to go to is going to be the present value of a dollar. This is being used for a single payment. Now, why is it that this is not worth $10 million today in cash? Because this is not going to be paid out to us until for 10 years from now. So the value of this payment to us is not $10 million today. Rather, what amount could I invest in at that market rate of interest and then ultimately receive $10 million? I have other videos that are out there about present value. Feel free to go look those up. So coming right over here, when I go to the present value tables, I need to know two things. How many times is interest being paid? In this case, it's a 10-year bond with two payments per year. Okay, so right over here, this is going to be 20, what we would call 20 periods. Now, I need to know another thing. I need to know the market rate of interest. Now, for my market rate of interest, the market rate of interest, whenever I see the market rate, it is always an annual rate. This is going to be 12%. However, to adjust to the semi-annual rate, I need to multiply the 12% because that's an annual rate by 6/12 or 6%. So when I go to the tables for this $10 million, I'm going to use 20 periods at 6%. So come over here, present value of a dollar. And I'm going to go here 20 periods because that's how many times interest is being paid at 6%. And that is going to be 0.31180. So 0.31180. So the value of this $10 million today is going to be 3.1 million. Now you might be saying to me, Bennett, that's absolutely crazy. How is this, 3.1 million worth? How is this worth $10 million? Well, if I were to say, come over here and look at this and say, okay, what if I invested this amount and the interest rate, and this would be every 6 months, was say 6%, which is really what we're saying it is. The semi-annual interest that I would earn on this would basically be 187,080. If I then took this interest and then reinvested this into the principal amount of basically $3,118,000, the value of this at the end of that first 6 months would be 3,305,000. Now, let's imagine this. If we're going through and doing this, it's going to be for 20 times because we're going to be doing this, and that just happened to work out magically. So if I take that amount after 6 months, I reinvest it, and then I basically roll that forward. If I go through and do this, by the end of year 20, this is going to be worth close to $10 million. So what this whole thing with present value does is it's taking an amount in the future and bringing it back to today's dollars because this 10 million is not going to have to be paid out for 10 years. Let's go ahead and look at the 500,000. Now, there's 20 different payments of this. And if I were to use this table, I would have to do 20 separate present value calculations. Who has time for that? Not me. So instead, what we're going to go through and do is we're going to say, okay, well, is there another table we can use? And this is going to be called the present value of an ordinary annuity of $1. When we use this table, what is an annuity? It means that the amount that's being paid out is exactly the same. So it is annuity. So what I can do here is I can use the same factor, 20 periods at 6%. So when I come over here, 20 periods at 6% is 11.46992. I bring this back over here to my amount of the 500,000. So the value of these 500,000 payments for the next 10 years or twice per year is going to be 5.7 million. That's what the value of this is today. Now, the total BROM proceeds is going to be the sum of the 3,118,000 plus the 5,734,960. If we come over here, the amount of the cash we're going to receive is going to be 8.85 million. This should be below the bond payable face value amount. My difference here is going to be my discount on bonds payable or whatever I need to go through and do to balance. So that's one example that we're going through and looking at. I have a lot of other videos out there about bonds. If you'd like links to them, please feel free to ask for them. Let's go ahead and take a look at another question. So we have over here, we have Dash Dion issued an 8-year bond with a face value of $12 million. The bond had a stated rate of 9%, and this is greater than the market rate of 8%. So if I'm offering more than what the market is, then theoretically my bond will sell for greater than the face value. So on 1/130, I am debiting cash because I'm always going to be receiving cash. I always credit bonds payable. Whenever I credit bonds payable, it's always going to be for the face value of the bond. Or right over here, this is going to be $12 million. Now, because the cash proceeds will be higher than the bond payable value, we're going to call this a premium on bonds payable. Okay, so we're going to call this to record bond issuance. So we're going to do the same thing. What is this bond going to pay out? Well, at the end of 8 years, it's going to pay out $12 million. And at the same time, it's paying out, has a stated rate of 9%. And this is being paid out annually or basically once per year. So the amount of the interest is going to be the face value times the stated rate. Annual interest is going to be 12 million times 9% or 1,000,080. Now, when I come over here to go through and look at this, now I have to say to myself, okay, I've got my $12 million face value that'll be paid out at the end of 8 years. And then I come over here and I've got 1,080,000 being paid out every single year for 8 years. Now, when I go to the present value tables, I'm going to go use, I need two things. How many times is interest being paid out? Because this 12 million is a one-time payment, I'm going to use present value of $1. This is going to basically be my market rate of interest or 8% market rate at 8 periods. Now, why am I not multiplying this by 6/12? Because this is being paid out to me annually. This here was semi-annual, so I'm focused on annual interest payments. So I come over here for the 12 million, come right over here, 12 million, 8 periods at the market rate of interest at 8% is 0.54027. Coming right back over here, 0.54027. So this $12 million in today's dollars that'll be paid out 8 years from now is going to be 6.4 million. Now, could we go through and do the same thing we did before? Sure. I can come over here and say, well, if we have 6.483 million and I'm earning 8% on that money, my annual interest is going to be 518,659. Okay. So, but unlike the other one, this is only being paid out to us 8 times. So over here, if we go through and look at this, basically at the end of the 8th year, it's now worth $12 million. That's how present value works. Let's go over here to the annual interest. This is for a single payment amount. Remember, it's like an interest-only loan. This is the principal amount or the face value. But with the interest, I would have to do 8 separate present value computations. I'm too lazy for that. I'm going to go to present value of a dollar. This is going to be 8 periods at 8% or that annual market rate of interest. Remember, I don't multiply it by 6/12. So 8 periods at 8%. And this is going to be present value of an ordinary annuity of a dollar, 8 periods at 8%. So what I'm going to do over here, I'm going to go 8 periods at 8%, and this is going to be 5.74664. I'm going to copy this over here. So then the value of this 1,080,000 is going to be 6,206,371. So my total cash proceeds is going to be the value of the 12 million plus the value of the interest payments. And lo and behold, the cash is greater than the face value, which is what we went through and expected. So my premium on bonds payable is therefore going to be the difference, or 689,611. So I have a lot of other I have a lot of other videos about bonds. This is a very brief example of how to go through and compute these quickly using present value tables. I hope you found these helpful, and I look forward to seeing you on the next video. Have a great day.